Income tax versus property taxes on inherited property. I'm Harrison Johnson with Wilsey Asset Management. There are many factors to consider when inheriting real estate, especially in California, and the tax impact is one of the largest. When receiving an inheritance of property, there is an income tax consideration and a property tax consideration. When capital assets, such as real estate, are sold for more than they were purchased for, the increase in value is considered a capital gain, which is a type of income. When property is inherited, it generally receives a step up in basis, which means the original purchase price is no longer relevant, and the new income tax basis is the value of the property as of the date of death of the owner. This means a parent who purchased a property for $200,000 and passes away when it is worth $1 million can leave it to their children, who will not be responsible for the tax on the $800,000 gain. If they do sell, they will only need to report income on the appreciation after the date of death or the amount over $1 million. This is obviously a benefit and applies to other types of assets as well, such as stocks and bonds. However, due to Prop 19, there may be a counteracting property tax implication when inheriting real estate. In California, the property tax assessed value can only increase by a maximum of 2% per year, even if the fair market value of the property increases much more than that. Because of this, people who have owned properties for many years are paying relatively little in property taxes compared to the actual value of their real estate. However, when the property is inherited, the property tax assessed value increases to match its fair market value, resulting in a much higher property tax bill every year going forward. As a result, vacation homes and rental properties that were great investments become unaffordable when the heirs receive them. This often causes the sale of the property, which fortunately can be done income tax-free due to the step-up received at death. There is an exception to this property tax increase where if children inherit the primary residence of their parents and begin treating that property as their own primary residence, they may add up to $1 million of value to the property tax assessed value before being required to pay any additional property taxes. Understanding these tax issues can help you determine when property should be held or sold before or after an inheritance. Stay ahead in the investment world by subscribing to our YouTube channel and weekly newsletter for the latest economic news, expert analysis, and market insights.